Hey everyone, welcome back. Today we're going to be tackling bond valuation, pulling out all the good stuff from these corporate finance textbook excerpts you sent my way.
Sounds like fun.
Yeah. Our mission is to basically help you guys become bond valuation pros. By the end of this, you'll know how prices and yields work, how things like time and risk can impact things, and how you can use all this knowledge to make smarter investment decisions.
Absolutely.
Hmm.
And you know what's really interesting?
What's that?
Well, our source material actually mentions this time when U.S. Treasury bills were trading at negative yields.
Negative yields. So you're saying investors were actually paying to lend the government money?
It sounds crazy.
It does. Why would anyone do that?
Well, it all comes down to this really unique situation during the 2008 financial crisis.
Hmm.
We'll get into those details later.
Okay, so maybe let's start with some of the basics. For those who might be a bit rusty on their bond terminology.
Sure. When you buy a bond, you're essentially lending money to an entity, like a government or a company.
Yeah.
In return, they promise to pay you back the principal, which is also called the face value, at a future date known as the maturity date.
Okay, so it's like a loan, but with a fancy name.
Well, there's a bit more to it than that. Many bonds also make regular interest payments called coupon payments. These payments are determined by something called the coupon rate.
Okay, so it's like a loan with some added perks.
You'd say that. Now, one of the most important concepts to grasp is the yield to maturity, or YTM for short.
YTM. Got it. What exactly is that?
Think of it as the annual return you can expect if you hold the bond until it matures. It takes into account the purchase price, those coupon payments, and the face value at maturity. It's basically the bond's own internal rate of return.
So YTM is what tells us how much we can potentially earn from a bond.
Precisely.
Got it. Now, I remember reading about zero coupon bonds, which don't make any coupon payments at all. How does that whole YTM thing work in that case?
Good question. With zero coupon bonds, like those U.S. Treasury bills we talked about earlier, the entire return comes from the difference between what you pay for the bond and the face value you receive at maturity.
So instead of getting regular interest payments, you're buying the bond at a discount and then getting the full face value at maturity. That makes sense. So back to those negative yields. How is it even possible for a bond like a Treasury bill to have a negative yield?
Well, during that 2008 financial crisis, investors were really spooked. They were looking for the safest place to park their money, and U.S. Treasuries were seen as basically the ultimate safe haven.
So even though they knew they might lose a tiny bit of money in the short term, they felt it was better than risking much bigger losses elsewhere.
Exactly. It all boils down to this idea of opportunity cost. Sometimes a small guaranteed loss can be preferable to the risk of a much larger loss.
I see. So it's not just about the potential return, but also the perceived risk.
Absolutely.
Mm.
Now let's talk about how we actually go about valuing these bonds. How do we determine how much they're really worth?
Yeah, that's the million-dollar question.
Well, for zero coupon bonds, it's fairly straightforward. We simply discount the face value back to the present using the appropriate discount rate.
Discount rate. What does that take into account?
It reflects things like prevailing interest rates and the time until the bond matures.
So the longer the time to maturity, the higher the discount rate.
Generally speaking, yes. That's because the further out we go into the future, the more uncertain things become.
That makes sense. So for those zero coupon bonds, we're basically bringing that future lump sum payment back to today's dollars using that discount rate.
Exactly. Now, what about those bonds that do make regular coupon payments?
Yeah. How does the valuation process differ for those?
Well, in that case, we need to discount each individual coupon payment along with the final principal payment back to their present values.
So it's like adding up the present value of all those future cash flows.
You got it. And to do this, we use a concept called the yield curve.
Oh, yeah. I've heard of that, but could you explain it a little more?
Sure. The yield curve basically plots the yields of bonds with different maturities. We can use this curve to determine the appropriate discount rate for each individual cash flow.
I see. So if a bond has coupon payments coming in 5 years from now, we'd use the 5-year yield on the yield curve to discount those payments back to today.
Exactly. Our textbook had a great example using a 5-year $1,000 bond with a 5% coupon rate that pays those coupons every 6 months.
Okay, I'm following you. So we discount each of those semi-annual coupon payments of $25 plus that final $1,000 principal payment using those appropriate discount rates based on the yield curve.
Precisely. And the sum of all those present values would represent the current price of that bond.
So it's like a giant financial time machine bringing all those future payments back to today's dollars.
A very apt description. But remember, bond prices are constantly changing. They're not static.
Oh, right, because interest rates are always moving up and down.
Exactly. When interest rates rise, newly issued bonds will offer higher yields to entice investors. This makes existing bonds with lower coupon rates less attractive, so their prices tend to fall.
And I'm guessing the opposite happens when interest rates decline.
Precisely. Existing bonds with higher coupon rates become more valuable in that scenario, so their prices rise.
So it's a classic seesaw effect. Interest rates up, bond prices down, and vice versa.
Exactly.
It's all about timing and those interest rate movements.
Absolutely. And it's not just those external interest rate changes that affect bond prices. The passage of time itself also plays a role.
What do you mean by that?
Well, as a bond gets closer and closer to maturity, its price naturally gravitates towards its face value, regardless of what happens with interest rates.
So even if interest rates stay the same, the price of a bond will still change as it gets closer to maturity.
Precisely. Now, our textbook mentions something called a sawtooth pattern with coupon bond prices. What's that all about?
That's a good question. That pattern emerges because of how interest accrues between those coupon payments. As a bond approaches its next coupon date, its price gradually increases to reflect that accumulating interest.
So it's like a little step up in price as we get closer to that next payment.
Exactly. And then right after the coupon is paid, the price drops down a bit, reflecting that one less payment is remaining until maturity.
So those coupon bond prices are constantly doing this little dance between payments, stepping up, then stepping back down, creating that sawtooth pattern.
Precisely. Now, another term that often tops up is dirty price.
Dirty price. That sounds a bit shady.
Not at all. It simply refers to the bond's actual cash price, which includes any accrued interest.
So if we're halfway between coupon payments, the dirty price would be the clean price plus half of the next coupon payment.
Exactly. The clean price removes that accrued interest, giving us a smoother picture of the bond's value over time. So the duty price is what we actually pay, but the clean price is more helpful for understanding those long-term value trends.
Exactly. Now, so far we've been focusing on those nice, safe government bonds, but what happens when we start looking at those issued by corporations?
Yes. Corporate bonds. I'm guessing things get a bit more complicated there.
They do. Corporate bonds, unlike those issued by governments, carry credit risk.
Credit risk. Meaning there's a chance the company might not be able to pay us back.
Precisely.
So those promised cash flows from a corporate bond aren't quite as certain as those from a government bond.
Exactly. And because of that added risk, investors demand a higher return.
So they want to be compensated for taking on that extra risk.
Precisely. Which means corporate bonds typically offer higher yields compared to government bonds with similar maturities.
That makes sense. We want a bigger potential reward if we're taking on more risk.
Right. And that difference in yield is called a credit spread, or sometimes a default spread.
So the riskier the company, the wider that credit spread will be.
Exactly. Our textbook used Avant Corporation as an example to illustrate this concept of credit risk and how it can affect bond prices.
Okay. How does their story play out?
Imagine a scenario where a risk-free treasury bill is yielding 4%.
Okay. So that's our benchmark.
Right. Now, if we had a one-year zero-coupon bond issued by Avant and it was considered completely risk-free, it would also yield 4%.
Because investors would have no reason to accept a lower yield from Avant if they could get the same return from a risk-free treasury bill.
Precisely. But, of course, in the real world, there's always some chance that a company could run into trouble and default on its debt.
Right. So let's say investors believe there's a chance Avant might not be able to pay back the full face value of their bond.
In that case, the bond's price would drop to reflect that potential risk.
And I'm guessing the yield would increase because investors would need a higher potential return to compensate for that added risk.
Exactly. Our textbook took it a step further and imagined a scenario where investors believed there was a 100% chance that Avant would default and only repay 90% of the bond's face value.
Wow. So almost a guaranteed loss.
In that extreme case, the bond's price would plummet and the yield would skyrocket because investors would need a massive return to make up for that almost certain 10% loss.
So the bond market is very good at pricing in risk.
Absolutely. Now, of course, in most cases, it's not so black and white. There's usually a range of possible outcomes.
Right. It's not always a sure thing that a company will either fully repay their debt or completely default.
Exactly. So investors assess the likelihood of those different outcomes and factor that into their pricing decisions.
So if there's a 50-50 chance that Avant makes good on its debt, investors would demand a higher yield than for a risk-free treasury bill, but not as high as if default were certain.
Exactly. The bond's price and yield would reflect that perceived probability of default.
This is where those credit rating agencies like Standard & Poor's and Moody's come into play, right?
Precisely. They assess a company's financial health industry outlook and management quality to determine their likelihood of default.
And then they assign those letter grades to those bonds.
Exactly. Those ratings signal to investors how risky the bond is.
So those top-rated investment grade bonds are seen as relatively safe, while those speculative or junk bonds are much riskier.
Exactly. And those ratings directly impact the yields investors demand. Higher rated bonds with lower perceived risk command. Lower yields, while riskier bonds have to offer higher yields to attract investors.
Makes sense. It's all about finding that balance between risk and reward.
Now, you mentioned corporate yield curves earlier.
Yeah.
How do those differ from those for government bonds?
Yeah. What's the story there?
Corporate yield curves are constructed similarly to government yield curves, plotting yields against maturities for bonds issued by the same company.
Got it. But I'm guessing those corporate yield curves tend to be higher than those for government bonds.
Exactly, because of that credit risk we discussed.
Right. That makes sense. That difference in yield between corporate and government bonds is essentially that credit spread we talked about.
Precisely. And those spreads can fluctuate quite a bit depending on market conditions and investor sentiment.
So if investors are feeling nervous about the economy, those credit spreads will probably widen as they demand higher returns to compensate for the perceived increase in risk.
Exactly. Now, finally, let's touch on sovereign bonds.
Sovereign bonds? You mean those issued by national governments?
Exactly. We've already talked about U.S. Treasuries as a benchmark for risk-free rates, but bonds from other countries can be a different story.
Right, because the risk a government defaulting on its debt can vary significantly from country to country.
Exactly. So those sovereign bond yields reflect a bunch of factors, including the country's economic health, its political stability, and its track record of repaying its debts.
It's kind of like those credit ratings for companies, but on a national level.
You could say that, remember all that drama a few years back with the U.S. debt ceiling debate?
Oh, yeah. That was a bit nerve-wracking.
It just goes to show that even those seen as the safest borrowers can have their moments of uncertainty.
It's a good reminder that nothing in the financial world is completely risk-free.
A valuable lesson indeed. Well, we've covered quite a bit of ground today, from those bond basics to those credit risk nuances and sovereign bond dynamics.
It's incredible how interconnected all these concepts are, and how those fundamental principles of valuation apply across different types of bonds. But I'm really intrigued by this idea of using zero coupon yields to unlock the secrets of pricing any risk-free bond.
It's a fascinating area that reveals a lot about how bond markets really work.
I can't wait to dive into that more in our next segment.
It should be an interesting discussion.
All right, well, stay tuned for part 2 of our bond valuation deep dive, where we'll continue to explore these concepts and unravel the mysteries of the bond market.
See you then.
Welcome back. All right, so let's dive into this whole idea of using zero coupon yields to value any risk-free bond.
It's all about replication. Imagine taking a coupon bond and breaking it down into a bunch of smaller zero-coupon bonds. Each of these mini bonds would mature at the same time as one of those coupon payments. Essentially, we're replicating the stream of payments from that original coupon bond.
So it's like we're creating a bond Lego set using zero coupon bonds as our building blocks. I'm starting to see how this ties back to that zero coupon yield curve we talked about.
Exactly. The cool thing is that we can then use that yield curve to figure out the fair price of any risk-free bond, even those with coupon payments.
Yeah, but why does this whole replication thing actually work in practice? What guarantees that the price of that coupon bond will line up perfectly with the combined value of those zero coupon bonds?
Well, that's where this concept called the law of one price comes into play.
A law of one price.
Yeah, it's a fundamental principle in finance. It basically says that if two investments have the same cash flows, they have to have the same price.
So if one is cheaper than the other, investors will just buy the cheaper one and sell the more expensive one until the price is equalized.
Exactly. That's arbitrage in action.
Yeah.
It's like those market forces we talked about, always working to maintain balance.
Makes sense. Our textbook had a good example using a 3-year $1,000 bond with 10% annual coupons. Could you walk us through how we'd replicate those cash flows using zero coupon bonds?
Sure. To replicate those cash flows perfectly, we'd need 3 zero-coupon bonds. One would mature in 1 year to match that first $100 coupon payment, another would mature in 2 years for the second $100 payment, and the last one would mature in 3 years to cover that final payment, which includes both the last coupon and that $1,000 face value.
Got it. So we're basically creating a synthetic version of that original bond using those zero coupon pieces. Now, how do we figure out the total cost of this zero coupon portfolio?
We'd simply calculate the present value of each zero coupon bond using the appropriate yield from the zero coupon yield curve. We'd use the 1-year yield for the 1-year bond, the 2-year yield for the 2-year bond, and so on.
Okay. And let's say for the sake of this example, those yields are 3.5%, 4%, and 4.5% for the 1-year, 2-year, and 3-year maturities, respectively.
Right. We plug those yields into our present value calculations and then add up those present values to get the total cost of that replicating portfolio.
And that total cost should be equal to the fair price of the original coupon bond, according to that law of one price we talked about.
Exactly.
Yeah.
Any difference in price would create an arbitrage opportunity, which those savvy investors would quickly exploit.
So it's a self-correcting mechanism keeping those bond prices in line with those underlying risk-free rates.
Precisely. Now, this whole replication idea also gives us a handy formula for directly valuing those coupon bonds using those zero coupon yields.
Oh, really? So we don't have to go through the trouble of building that entire zero coupon portfolio every time.
Exactly. We could just plug those yields into a formula and get the fair price directly. It's much more efficient.
That's pretty cool. So that zero coupon yield curve is like a master key unlocking the value of any risk-free bond.
Exactly.
Yeah.
Now, I know this might sound a bit strange, but even coupon bonds that have the same maturity date can have different yields to maturity.
Really? Why wouldn't investors always just go for the bond with the highest yield?
Well, it comes down to how those coupon payments are weighted in that overall yield calculation. Higher coupon payments mean those early cash flows have a bigger impact on the bond's present value.
So the timing of those cash flows matters, not just the total amount.
Exactly. And here's where the shape of that yield curve comes into play.
How so?
Well, if the yield curve is upward sloping, meaning longer-term yields are higher than shorter-term yields, bonds with higher coupons will actually have a lower yield to maturity compared to those with lower coupons, even if they mature on the same date.
So it's almost like those early, lower-yielding cash flows drag down the overall yield when those longer-term yields are higher.
Precisely. Our textbook had an example comparing a 3-year zero coupon bond to 2 different 3-year coupon bonds. One with a 4% annual coupon rate and another with a 10% coupon rate.
Oh, yeah, I remember that one. So using those same zero coupon yields we talked about earlier, 3.5% for 1 year, 4% for 2 years, and 4.5% for 3 years, we can calculate the yield to maturity for each of those bonds.
Exactly. The 3-year zero coupon bond obviously has a yield to maturity of 4.5% because that's the 3-year zero coupon yield. But that 3-year bond with the 10% coupon rate ends up with a yield to maturity of only 4.44%, slightly lower than that zero coupon bond.
So even though it's paying out more in coupons, that higher coupon bond has a lower overall yield to maturity.
Exactly. And the 3-year bond with the 4% coupon rate ends up with a yield to maturity of 4.47%, even though its coupons are smaller than that 10% coupon bond.
Wow. So in this case, that lower coupon rate actually leads to a slightly higher yield to maturity.
Precisely. And it all comes down to how those coupon payments are weighted against those longer-term, higher-yielding zero coupon rates baked into that yield curve.
Fascinating. So it's not just about looking at the coupon rate in isolation.
Yep.
We have to consider the timing of those payments and the shape of that yield curve to get the full picture.
Exactly. Now let's shift gears a bit and talk about some of those alternative investment decision rules that companies sometimes use.
You mean things like the payback rule and the internal rate of return? I've always been curious about those.
They definitely have their place, but it's important to understand their limitations and when they might lead to different decisions compared to our trusty net present value, or NPV.
Let's start with the payback rule. It seems pretty straightforward at first glance. You just look at how long it takes for a project's cash flows to cover the initial investment.
Exactly. The payback rule is appealing because it's simple. You just calculate how long it takes for those cumulative cash flows to reach or exceed the initial investment. If that payback period falls within a predetermined time frame, the project gets the green light.
So it's a quick way to assess how fast a project will pay for itself. But I'm guessing there are some downsides to this approach.
There are. The main drawback is that it completely ignores the time value of money.
Ah, right. That whole idea that $1 today is worth more than $1 tomorrow.
Exactly. It also disregards any cash flows that occur after that payback period, which can lead to some short-sighted decisions.
So we might reject a project that has great long-term potential just because it takes a bit longer to recoup that initial investment.
Exactly. Now, the internal rate of return, or IRR, is a bit more nuanced.
How so?
Well, it's the discount rate that makes the project's NPV equal to 0. It's like finding the break-even point where the project's return matches the required return.
Okay. So if a project's IRR is higher than the company's cost of capital, it's a good investment.
In many cases, the IRR rule will lead you to the same decision as the NPV rule. But there are certain situations where the IRR can be misleading or even give you multiple solutions.
I remember reading about those IRR quirks, like when a project has cash flows that change sign multiple times, you can end up with multiple IRRs, making it tough to know which one to use.
Exactly. And sometimes there's no IRR at all. In those situations, the NPV rule is much more reliable.
So the NTV rule is like that trusty compass always pointing us in the right direction, even when those other rules might get us lost.
I like that analogy. Now, what about those situations where we have to choose between multiple projects? Those mutually exclusive investments.
Ah, the classic dilemma of picking our favorite child. How do we decide when we can only choose one?
Well, in those cases, the NPV rule still reigns supreme. We simply calculate the NPV for each project using its specific cost of capital, and then choose the project with the highest NPV, even if it doesn't have the highest IRR.
So choose the project that creates the most value. Makes sense. But I'm guessing some folks are still tempted to use the IRR rule in these situations. Why is that a bad idea?
Because the IRR doesn't take into account the scale of the investment or the timing of those cash flows.
Right. We could end up choosing a project with a super high IRR, but it only involves investing a tiny amount of money.
Exactly.
Not cool.
Or we might have two projects with similar initial investments, but their cash flows come in at different times. In those cases, the IRR can be misleading.
So a project with a lower IRR might actually be more valuable in the long run if its cash flows are spread out over a longer period, allowing for more compounding.
Exactly. And we also have to consider risk. Comparing IRRs without taking into account the risk profiles of those projects is meaningless.
Right. A 10% IRR on a super safe government bond is very different from a 10% IRR on a risky startup.
Exactly. So remember, when it comes to those mutually exclusive projects, the NPV rule should always be our go-to decision-making tool. It's the only way to ensure we're truly maximizing value, considering all those factors.
Sounds like a solid plan.
Mm.
Now, what about those situations where companies can't fund every promising project because they have limited resources? How do they handle that?
That's a very real challenge. Companies have to prioritize and allocate their capital wisely. One way to do this is to use something called the profitability index.
The profitability index, what is that?
It's basically a metric that helps companies rank projects based on how efficiently they use those scarce resources.
Okay, how does it work?
It's pretty simple. It's just the ratio of a project's NPV to its resource consumption, which is usually measured in dollars invested.
So it tells you how much NPV you're getting for every dollar you spend.
Exactly. Once we've calculated the profitability index for each project, we can rank them from highest to lowest and start funding them in that order until we run out of money.
So we're picking the projects that give us the most bang for our buck.
Exactly. But there are a couple of things to keep in mind.
Like what?
First, this approach works best when those chosen projects completely use up all the available resources. If we have money left over, we might be missing out on some extra value creation.
It's like trying to fit puzzle pieces together perfectly to get the complete picture.
Exactly. And second, the profitability index works best when we're dealing with a single resource constraint, like a limited budget. If we have multiple constraints, things get more complex.
So if we have both a budget limit and a staffing shortage, for example, we might need some fancier tools to figure out the best solution.
Precisely. But even with its limitations, the profitability index is a valuable tool for making those tough capital budgeting decisions.
Great. So we've covered a lot of ground today, from those basic bond principles to those alternative decision rules. There's just one more thing from our source material that I'd like to discuss.
What's that?
Bond arbitrage. It sounds a bit like financial alchemy, squeezing profits out of thin air by taking advantage of those tiny price differences in the market.
It's definitely an intriguing area that highlights how interconnected and efficient financial markets can be.
So bond arbitrage is more about market efficiency than magic.
Precisely. Those market forces are constantly working to eliminate those price discrepancies.
It's like those natural forces that keep things in balance.
Exactly. Now, remember how we talked about replicating the cash flows of a coupon bond using a portfolio of zero coupon bonds?
Yeah, that was pretty cool.
Well, that concept is key to understanding how bond arbitrage works. Let's go back to that 3-year $1,000 bond with 10% annual coupons. We found that its no arbitrage price was $1,153 based on those zero coupon yields.
Right. But what if that bond was actually trading for less in the market? Maybe around $1,120.
I would definitely catch the attention of those arbitragers.
Gee, they could potentially buy that undervalued bond and make a quick profit.
Exactly. They could buy that coupon bond for $1,140 and simultaneously sell a portfolio of zero-coupon bonds that perfectly replicates its cash flows for $1,153, locking in a $13 profit without taking on any real risk.
That sounds like a pretty sweet deal.
It is. But in reality, things aren't always that simple.
Oh, right. There are always those pesky real-world factors to consider.
Exactly. Transaction costs like brokerage fees can eat into those profits, and those price discrepancies often disappear quickly as other arbitrageurs jump in and capitalize on that opportunity.
So it's a constant race to find and exploit those mispricings before they vanish?
Precisely. But even though those arbitrage opportunities might be fleeting, the principle of bond arbitrage is still crucial. It helps to ensure that bond prices stay relatively in line with those underlying risk-free rates.
So it's like this behind-the-scenes force that keeps the bond market functioning smoothly.
Exactly. Now we've explored a lot of ground in this deep dive, covering everything from those bond basics to those arbitrage strategies.
It's been quite a journey. But there's one final thought I'd like to leave our listeners with.
Oh, what's that?
Well, we focused a lot on how bond prices react to changes in interest rates, but we haven't really talked about what drives those interest rate movements in the first place.
That's a great point. Those interest rate changes are influenced by a whole host of factors, both economic and political.
Right. Things like inflation expectations, economic growth projections, and central bank policies all play a role.
Exactly. It's a complex interplay of forces. So as you continue to learn about bonds, remember that understanding those underlying drivers of interest rates is just as important as mastering those valuation techniques.
Absolutely. Well, I think we've covered a ton of ground today, from those bond fundamentals to those more advanced concepts like arbitrage and macroeconomic influences.
We've certainly packed a lot into this deep dive. Hopefully our listeners are feeling much more confident about navigating the world of bonds.
I think so. We've demystified those bond prices and yields, explored how time and risk impact valuation, and even uncovered those hidden connections between zero-coupon yields and coupon bond prices.
And don't forget those key takeaways. Bond prices and yields move in opposite directions. Time and interest rates are those constant forces shaping bond values. And that NPV rule is our trusted guide for making smart investment decisions.
And those zero-coupon yields, they're like the secret code underlying the entire bond market.
Exactly. So next time you hear those financial news commentators talking about the bond market, you'll have the knowledge to understand what's really going on.
And hopefully make some informed investment decisions along the way.
Until next time, may your financial journey be filled with profitable discoveries.
Happy investing, everyone!